Hi, everyone. Thank you so much for joining Building Wealth by Investing in U.S. Real Estate. If you guys don't know me, my name is Jean. I'm the founder of Mada Partner and Mada Capital. We've been investing in U.S. real estate for just over 7 years. And what we've been doing is sharing the wealth of knowledge that we've been getting over the years. And we're also like to get the people involved in our success, involved in other people's success, and we create these series of webinars just to share the information that we've been able to gather over time. And tonight I have the pleasure of having Jean Pierre Laporte from Integris Pension Management Corp. And today we'll just be talking about personal pension plan. And I'll let Jean Pierre introduce himself. And again, before we start, also do not forget to subscribe to our YouTube channel, and this way we can keep producing some great content for you guys. Once again, all right, guys. So we'll start the presentation. Thank you again to attending one of our webinars. I've had the opportunity to speak with Jean Pierre over the last year and decided to present his product to people that are in my ecosystem, in my network. What he's offering for the personal pension plan is quite interesting. It's a kind of good way if you have a corporation that you can add that to your real estate portfolio as one of your strategies. So I'll let Jean Pierre take over.
Okay, thank you, Mathieu. So the topic tonight, of course, being PPPs in real estate investing, and usually with a US focus. I wanted to start by just, before I even get into the roadmap, just a couple of words about myself, just in case people have questions down the road. So I'm a pension lawyer, and I've been practicing pension law for about 22 years. And my passion is registered pension plans. And of course, pension plans have much broader investment opportunities than RRSPs, for example. That's why special asset classes like the 407 toll highway in Toronto is owned by a pension plan. And certain funky assets like Cadillac Fairview, the Eaton Center used to be owned by a pension plan. And so I wanted to make sure that folks in the small private sector who aren't government bureaucrats, who don't belong to union, who don't belong to a very large enterprise, would be able to have all the benefits of true gold-plated pension plans through their own private corporations, and therefore would be able to invest in more sophisticated asset classes like private real estate. And so that's just 2 words about myself in terms of background. So the roadmap tonight, and this is kind of the punchline. So for those who have to leave after this slide, you'll get 90% of what it is that we're going to be talking about. So the executive summary is that it is possible to do tax sheltered investments in the US private real estate today. When I mean tax sheltered, I mean no capital gains, no tax on interest. So that means you can get richer faster because you don't have the tax authorities eating away at your returns. And also we can avoid a lot of the IRS headaches because we file under the W-8BEN-E exempt form. So for those who are familiar with that, and we'll get to it later, that's a way of not having to declare and pay any income tax in the United States. So how do we achieve this? How can we do tax sheltered investment in US private real estate? Well, first, of course, you got to set up a personal pension plan, which is part of the presentation. And then you got to partner with Mada. So that's the that's the punchline. Let's get into the details then. So what is the process to follow? Well, first of all, you got to set up a personal pension plan. Then you got to fund it. You got to put money in it. And once those monies have been put in there, we can deploy them in US real estate. Now, why would we use a personal pension plan and not an RRSP? Well, assuming that you could invest in private real estate with an RRSP, which very, very, very difficult. The personal pension plan offers the greatest tax deductions to business owners in Canada. The law is, the way it's designed, it's a lot more generous when it comes to tax deductions if you're using pension rules than if you're using RSP rules. And I'm not even going to talk about the tax-free savings account because it only has a $6,000 annual limit. So that's why if you look at this graph, you can see that the tax-free savings account is at the very bottom because it has such a low contribution limit. But when you compare our product to other types of tax sheltered accounts, you can see that for the exact same amount of rate of return, so the same level of risk, because we're allowed to contribute more, you end up with more money in retirement than the other strategies. So that's why. And how do we actually achieve that? How do we get more money to work for us thanks to pension legislation? Well, we do it because we have access to 6 additional tax deductions that you don't get with an RSP. We can do what's called a buyback of past service. If the business has paid a salary in previous years, we can retroactively recognize all those years that the company was paying a salary, and we call that past service. So the company, the professional corporation or the regular corporation that we own, will cut a check to the pension plan, to the PPP, and that contribution is tax deductible fully, dollar for dollar. We can do higher annual service or higher annual contributions than an RSP. For example, by the time you hit around age 64, you can put $20,000 more in our product than you could in an RSP. So you can do whatever an RSP does and then add another $20,000 at age 64. It's less if it's younger, but that really adds up year after year. We can even do an RSP double dip in the first year. So in the year that we set up a PPP, you could do a buyback of past service, a higher annual contribution than the RSP, and an RSP contribution. And people always ask me, well, how can that be possible? How can a CRA allow you to put money in 2 separate registered plans that are going to give you tax deductions and therefore potentially tax refunds? How can you do that? And the reason is simple. By law, the RSP contribution in 2022, this year, is based on 2021 earned income. It's always late. With the pension plan, your 2022 contribution is based on your 2022 salary. So in 2022, we have both an RSP contribution and a PPP contribution. And of course, this RSP can be rolled into the PPP on a tax-free basis as well. So you can add it to your pool that's going to go to MADA. Special payments. So this is a special rule that applies only to pension plans. And it says that if the internal rate of return inside the pension plan is below 7.5%, what will happen is there's going to be a deficit that starts to build up within the plan. And we can top up this deficit. We can ask the corporation that set up the PPP, our own corporation, and we can ask it to take pre-tax dollars, the dollars that haven't been taxed yet, and contribute them directly to the pension plan under the special payments category. And that's also 100% tax deductible to the business. So if you are investing and you're not making any income because it's just capital appreciation and the rate of return is 0, well, then you're fully loading up. You might be doubling or tripling your tax deductions year after year. That's kind of nice. Terminal funding is the ability to pre-fund and accelerate tax deductions if you decide to turn on the pension from your own PPP before age 65. Now, this doesn't mean retiring in the classic sense of, you want to play golf or reading a book on the beach and doing nothing. You can still run your business. You can still earn income. You're just going to collect some dividends because you're a shareholder. Plus, you're going to have a pension now that's going to replace a salary you might have been pulling out of your business. So you can have your cake and eat it at the same time. And the terminal funding, just so you know, some of the terminal funding deductions that we've seen, the record is $2.1 million. So imagine you have a really good year, you've made $2 million of revenue. Normally you'd be taxed at some percent, but no, you're going to take the full 2 million and put into your pension plan. So the company claims a $2 million corporate tax deduction. So that year the corporation pays zero tax. You don't have to declare the $2 million in your income because it went straight from the corporation to the pension plan. It didn't flow through your salary. So there's no personal tax on that $2 million. And now that $2 million is growing tax sheltered for X number of years. Pension adjustment offset amount is a very small $600 extra RSP contribution that is allowed in subsequent years after the first year. So there you go. You can see that without taking additional risk, because you're allowed to put a lot more money than an RSP, and that money is growing at the same rate of return, mathematically, you're going to end up being a lot richer. The bottom line is we can offer 3 times, sometimes more, 4 times, more tax deductions than an RSP over a lifetime. And the basic conclusion is, well, if you can deduct more, you're saving more on taxes immediately because it's mathematic. You're not taking risks in the market. You just file your tax return and claim a larger deduction. CRA can't hang on to your money. They have to refund it to you. So that's like an immediate rate of return, guaranteed. Plus, if you contribute more, you've got more capital growing in a tax-exempt account. So again, all else being equal, you're going to end up being richer. So just to give an example, if we take a 50-year-old that has had their corporation for 15 years, taking a salary of about $120,000, but right now they've bumped it to $140,000, you can see on this graph the 2 growth curves, and we're using a 7.5% rate of return. You can see that the RSP curve is trending up. And then because we're allowed to put more money in the PPP, there's a gap that develops between the 2 strategies. They're both growing at 7.5%. But by age 70, we have a $1.6 million advantage to the PPP customer. So my question is, do you want it, or do you want to stay in an RSP? Because it's a free country, right? Nobody's forcing you to become richer if you don't want to. So the next question is, how do we set up a PPP? Well, first we have to determine suitability, make sure you qualify. Are you a business owner or shareholder? Do you own at least 10% of your company? Or are you married to someone that owns 10% or more? Or are you blood relation to someone that owns 10% or more? All of these people will qualify. Are you getting T4 income, like salary or bonus, or a combination of the 2 from that company? Because if all you take is dividends, sorry, you can leave the webinar right now. Won't work. Are you under the age of 71? Unfortunately, there's a limit, and we can't do this for people over age 71. You're not allowed to join a pension plan if you're over 71. And perhaps the most important is, do you have excess cash in your holdco or operating company or family trust that is being taxed while being invested? Because if it's not in a registered environment like a pension plan, depending on the type of investment, it could be punitively taxed. If you look at the tax rate of foreign dividends paid to a corporation that's investing its money in a passive manner, it's over 50%. And then you have to pay tax again when you declare a dividend to yourself. You have to pay personal tax. So why burn half the wealth every year while it's being invested this way when you can pay zero tax, having that same money growing inside of a pension plan? So first step is to get an illustration. You can go to the Integris website. It's a secured website. And you click on the Get Started button, and you're going to get a questionnaire that asks you some basic data. You know, what's your date of birth? How much T4 income did your company pay you in the past years? And then what happens is our team takes that data and crunches it using our actuarial software, and we give you a 15-page long PPP quote that shows you in excruciating detail all the tax deductions from now until some retirement age that you've told us you'd like this projection to end at. It'll show you past service, current service, special payments, thermal funding, all the good stuff that we were talking about earlier that you don't get with an RSP. You get to see all of these deltas, these extra deductions. Step two is once you have your quote in hand, you review it with your advisors. Make sure your lawyer, your accountant, your financial advisor, your planner, the people you trust can do some due diligence, review the numbers, make sure it fits in with the broader financial plan. Of course, everyone has questions, and that's where the Integris sales team is there. So we can book a conference call, a video call, depending on the location. We may even do a site visit, and then answer all of those tough questions that people always have, like, what happens if I die? What happens if I get divorced? What happens if I go bankrupt? What happens if I leave the country? All of, and there are 100 different other questions. We have answers for that. Of course, our website has tons of frequently asked questions, but often people want to just ask the question live. They don't want to read anything. So, but we have both for those who are self-study. Step three is just to implement the plan. So the Integris onboarding team will collect additional information that we didn't collect at first because we didn't need it. And from the client or the advisor or the accountant, whoever's got the data. And then we work with our actuarial team. So we use IA Professional Services, which is the IA Financial Group is the 4th largest life insurance company in the country. That's our back office for actuarial and administration work. So we work with them and we get the plan registered with the Canada Revenue Agency, with the Registered Plans Directorate. That gives us the tax-free status that's so important for all of the stuff we're going to be talking about now. So step 4 is we fund the plan, fund the PPP. And there are really 2 primary sources of cash or assets that we can roll into the PPP. We can do corporate contributions for past service or current service. Of course, thermal funding, special payments, I could have put here as well, but at first we just do past service and current service. So that means annual service. And we can also transfer RRSP monies. So we could transfer existing RRSPs or RIFs. So people who have RIFs can roll them on a tax-free basis into the PPP. We can also do spousal RRSPs, but only if the spouse is also a member of the plan. Maybe they're on the payroll, we help out. So if the spouse has a spousal RRSP that I contributed to for my spouse, legally those assets are my spouse's, they're not mine, even though I made a contribution. So that my spouse, if she joins the plan, is able to roll her spousal RSP into the plan as well, and her personal RSPs as well. And we provide all the numbers because once we file the plan with CRA, we have what's called a contribution statement that sets out what you can transfer, how much you can contribute, all that good stuff. Just a quick note, when we're funding the PPP, corporate contributions are tax deductible to the sponsoring corporation. 100%. It's not like 50% like meals and entertainment. This is 100% of what you put in is tax deductible when you file your corporate taxes. And registered monies, whether they're RRSP, spousal RRSP, RIF, all of those, they're not deductible, but they're not taxed either. The transfer operates free of tax, thanks to the CRA form T2033, which some of you may be very familiar with. So no tax on transfer. Okay, now it gets fun, because now we're going to be talking about our hosts. So step 5 is really to deploy this pension cash to US real estate. Because now that the PPP has been funded, the plan is a superannuation or a registered pension plan. And that means that we're no longer caught by the RRSP qualifying investment rules. If you look at the RRSP qualifying investment rules and income tax regulations, there's a whole laundry list of what you're allowed to invest in. But for us, we don't follow those rules. We follow the registered pension plan rules, what are called the federal investment rules. And those have always allowed investing in private real estate. That's why so many large pension plans own office buildings in downtown Toronto. Now, they might be kicking themselves right now after COVID, but they definitely have access to that asset class. And what's beautiful is that we can invest in private real estate on both sides of the border, not just in Canada. There used to be a time when you were restricted. You couldn't put more than 30% of the pension plan outside of Canada. Those were the foreign content rules, but those were all abolished. So now we can put all of the cash in the US if we want to. We don't have to invest in Canada at all with the PPP. And finally, enters our host. So the expert would scope out the high-grade real estate in the US or other jurisdiction, and then explain the metrics, the economics, what kind of risk we're talking about, what it looks like. And the PPP would be able to purchase shares of a tax-exempt pension real estate investment corporation. So that's another creature of the Income Tax Act that allows pension plans to allocate some of their retirement capital for real estate acquisitions. And it's this pension tax exempt entity that would then be able to cut a check and say, hey guys, what's good? What seems to be a good buy? So very simple structure. Now, for those who are very familiar with US taxes, I wanted to spend one minute on US tax consequences. So it's important to remember that the PPP is a registered pension plan under the Income Tax Act. And as such, it's a superannuation plan under the Canada-US Tax Convention. So both countries treat the plan as exempt from taxation. And that's the reason why when a PPP crosses the border to invest in the United States, whether it's real estate or anything else, private equity, mortgages, public equities, it has to register with the IRS and uses the W-8BNE form, which I'm flashing here very quickly. I'm sure a lot of you are very familiar with it. So what we check off the exempt retirement plan box and complete part 15 of the form. And part 15 provides special treaty benefits, which I'm not going to get into details, but that's what all large pension plans that are investing across the border from Canada do. Okay, now, next question. What if my single PPP that I set up with my corporation just doesn't have enough money, even though I rolled in my RSPs and I had my wife roll in her RSPs and her spousal RSP, and I contributed for past service. And, I was able to scrape together some decent money, but it just doesn't move the needle. It's not enough money to make a meaningful acquisition of US real estate. Well, it is possible to get multiple and unrelated PPPs from different individual companies to federate, to join together in order to achieve meaningful scale. And the beauty is that the owners of these PPPs do not need to be related to one another. So if you have groups of like-minded investors that like to invest in US real estate, they can pool their resources together using those real estate pension investment corporations that I was just talking about. So let's go through a very simple example to illustrate. Imagine that a bunch of professionals, but it could have been a Tim Hortons franchisee with a dentist, with I don't know, an architect and a vet. It doesn't matter. As long as they have a corporation that they're running the business through, and as long as those corporations are paying these people a salary, they're all eligible to have their own PPP. None of them know each other. Well, they may know Mathieu, but they don't know each other. So they set up PPPs. And then they said, hey, let's go into some US real estate. So we would be setting up a real estate investment corporation. And it's that corporation that would be investing in the US real estate. So that when tenants are paying rents to the landlords, those rents are not taxable because the corporation is tax exempt. And that makes sense because all the PPPs are tax exempt. Likewise, if Mathieu's company decides to flip the building and sell it, and there's a big capital gain, well, the landlord is tax exempt. And all the profits can be distributed to the shareholders, which are all the different PPPs, tax exempt. To me, that's much better than paying tax, but I'll leave it, you to come to your own conclusions. And in terms of liquidity, in order to allow one PPP to pull out, we would have a unanimous shareholders agreement that would dictate under which conditions you can get your money back, with the usual clauses, right of first refusal, and all the good stuff you find in the unanimous shareholders agreement. So people don't feel like their money is trapped and can never come out. So that's it. I didn't want to take too much time. I really wanted to leave time for questions. We wanted to make this a little bit more interactive and fun. But I'll pass it over back to Mathieu. And I see there's a couple of questions that came in. I'm not sure. I didn't look at the chat.
I'll go through them in a second, but maybe talk about, if a family, let's say if there's a family business and let's say the father passes away and they're holding real estate about the tax implication. I think that's a good way too for transferring wealth, generational wealth. So maybe
sure. Yeah.
Talk about that. I think it's important for people to know this.
Sure. So unlike an RSP, with an RSP, if you die, let's say you don't have a spouse, you're a single person, or heaven forbid, you die in the same car accident with your spouse. If you have an RSP or a RIF, or you own shares of a company, a private company, you're going to have what's called a deemed disposition under the Income Tax Act. So the CRA deems that you sold everything the day before you died at fair market value. And because you sold everything, now you have a tax problem. You have to pay taxes, even though nothing was sold. Hence the word deemed. So that's terrible because for a lot of people, that means half their wealth is going to be siphoned off to CRA on death. So the children only get half, sometimes less, depending on the province, less than half the value that the parents painstakingly accumulated for their retirement. With a pension plan, with a PPP, that doesn't happen if the children are also members of the plan. And of course, the only way the children could be members of the plan is if the company pays them a salary, which doesn't have to be a lot. It could be minimum wage, half part-time. So half the minimum wage is enough. But if the members of the family, especially when it's a family business, if the members of the family are part of the plan and disaster strikes, car accident, whatever, what happens is that all the money inside the pension plan that would have been used to pay the pensions now becomes what we call pension surplus. It's surplus because there's no one to give it to. The pension plan promised a pension for the rest of your life, but if you die, the pension plan has discharged its obligations to you. So what does the pension plan do with all the money? Well, it becomes surplus. And so long as you have other family members in the plan, they can draw on that surplus for their own purposes. So it's like you're shifting money from one generation to the next without exposing it to immediate taxation, without the deemed disposition problem. And if I may, I'll just give you one single anecdote because I think it really stresses the point here. I had a client from Alberta who came to us and he had a pension plan and he was the only member in it. And he had done extremely well with private real estate investing. So he had $8 million of value inside of his pension plan. And I asked him, I said, hey, don't you run a family business? He goes, yeah. So why aren't your kids part of your plan? And he goes, I don't know, no one's told me I should. So I said, well, make them members of your plan because if you die tomorrow, instead of giving $4 million to CRA, you can give that $4 million to your children instead. Because all the $8 million will be surplus. And your kids, by being plan members, by virtue of being members of the plan, that money is theirs now. And he couldn't believe me. He was like, he almost cried, to be honest. He said, you know what? I'm 73 years old. No one in my life has ever told me that I could do this. I said, well, I guess they're not talking to pension lawyers. So in a 15-minute conversation, I saved his family $4 million in taxes. That's the power of the PPP.
And maybe touch on, let's say you're not in real estate, just for an example, you're on the stock market and your stocks took a beating, how you can overfund it and still have access to the tax benefit. I think that's an important thing to look at so people can understand how it could relate to real estate too.
Well, you remember my slide where I was talking about special payments, where I was saying that if the internal rate of return on assets is below 7.5%, you don't have enough money in the plan, and you're allowed to take more money from your corporation that's that hasn't been taxed yet, or pre-tax, and dump it into your pension plan, and therefore claim a deduction. So that's the concept of special payments. Well, imagine that instead of losing a couple of percent, or let's imagine that instead of earning 7.5, you're earning 5% or 4%, because I don't know, maybe you're on some bonds or something a little less risky. Imagine that instead of that, we have March 23rd, 2020 rolls around again. And I don't know about you, but I think the Toronto Stock Exchange lost 36% in a single day on that March 23rd. So a third of your wealth has evaporated in a single day because the market tanks. If you're using an RRSP and you've always maxed out your RRSP every year, you've always made your contribution, and then your RRSP account melts by a third, like 36%, there's nothing you can do. CRA is not going to allow you to put more money in your RRSP because you lost a third of it. You maxed out. You've always put in the maximum, and that's it. You just have to pray that the stock market will recover. But not so with us. Remember the special payment rule. So if you lost a third of your money, we can file what's called an ad hoc actuarial valuation report with the government and say, look, we lost a third of the money. Please let us contribute a few $1,000,000 back in there. And they do. They'll let you do it. So the company is claiming massive tax write-offs. That's point number one. Then all this money lands in the pension plan. Well, this is bargain hunting season because the expensive stocks that were 36% more expensive yesterday are now 36% cheaper. It's the same stocks, the same company, but now they become really affordable. And you've got all this money that your company just contributed from its pre-tax dollars. So you can go on a hunting spree. I'm not using the right term. You can go on a shopping spree or bargain hunting, mixing my metaphors. So now you buy, I don't know, I'm going to use Tesla. Maybe that's not the right stock, but Tesla at 36% cheaper, and the markets start to recover as they did after March 23rd, 2020. The markets start to recover. So you start selling those stocks and you generate capital gains. Well, those are not taxable either because it's a pension plan. So now you're back in cash. So when the next time the market collapses, again, you go and you pick up these cheap securities that people paid a lot of money for. Now you're getting them for a song and dance. So that's the power of understanding pension laws and utilizing stuff like special payments when you've got these fluctuations in the market. That's true.
All right, so I'm gonna go through the question. Maybe stop sharing your screens because I'm recording it, and like that we can have a better visual too. If people want to ask questions too, they're welcome to ask on camera. So Hong Lu had a few questions. No tax in the U.S., but you still have to pay it in Canada.
Well, when you start drawing a pension from the pension plan, that income is taxed in your hands. However, there are 3 different ways to minimize the tax burden. The first one is to become a non-resident. Because again, I'm going to use the United States. Under the US-Canada Tax Convention, while Canada would normally tax you at 25% as a non-resident on your pension income, thanks to the treaty, they only tax you at 15%. So on my $100,000 pension that's being paid to me every year, I only pay $15,000 in Canada, plus whatever the US authorities have taxed me with. But going from 25 to 15 is not a 10% drop. It's a 40% drop in your level of taxation, right? So that's pretty significant. So that's one way, if you become a non-resident. The other way is if you have a spouse and you do pension income splitting with your spouse. Because if you take your $100,000 a year pension and you take 50% of that and you roll it over to the tax return of your spouse, you only have to pay tax on the $50,000. Sure, your spouse will have to pay tax on the other 50, but assuming the spouse has no or lower income, the couple ends up saving thousands and thousands of dollars of taxes every year, thanks to the income splitting rules. So that's another way to reduce what is otherwise taxable. And it's important to note that if your annual pension from the pension plan is $30,000, right now, when you split it with a spouse, the couple pays absolutely no tax. The first 30 grand come out tax-free because you have the income splitting, and then both parties can claim their personal tax credits, and then both parties can claim the non-refundable pension amount credit every year. So when you tally up all of those credits, it wipes out all the personal tax on the first $30,000.
Can you use your lira to transfer it to transfer that into your pension plan?
No, not anymore. Liras are no longer permitted because in December of 2020, Ontario passed legislation that exempts our pension plan from the funding rules, the Pension Benefits Act. And as a result, the regulator won't allow us to take locked in money anymore that came from a pension plan.
How does this tax saving strategy compare to an IFA?
Well, it's completely different. An IFA is you're using after-tax dollars because you don't get a deduction for contributing to an IFA, to a permanent life insurance policy that's then funded through an IFA. And for those who may not know, they call IFAs immediate financing arrangement. So it's a way of borrowing against the policy that you purchased. But when you purchase that policy, you're doing so with after-tax dollars. What's interesting, and I know this may not be appropriate for a US real estate forum, but just for people's education, we can buy permanent life insurance policies within the pension plan as well. So it has an investment account and a death benefit. So those who really love permanent life insurance policies as an asset class, maybe to complement US real estate, that's something we can do, except we're doing it with pre-tax dollars. So we're getting a lot more money working for us from the get-go. So how does it compare? Well, like I said, they're completely different beasts. A lot of people set up permanent life insurance policies funded through an IFA because they know they're going to have a huge tax liability when they die, and there's going to be a deemed disposition, which is the stuff we were talking about earlier. So a lot of this tax-free death benefit that the life insurance company pays, either your corporation or you personally, depending on who's the beneficiary, that money is being used to mop up tax liabilities created by the deemed disposition. But what if you don't have a deemed disposition? Well, the insurance can now go directly to your beneficiaries tax-free. To me, that's a better use of money. So the two strategies are not meant to be either or. It's not black and white, or it's not a zero-sum game. They're actually synergistic. They work together. Because, for example, if I have a successful company and I'm prepaying my taxes corporately every quarter or whenever, based on historical track record, and I set up a pension plan and I start directing money to the pension plan, pre-tax money, I'm going to be able to claim those taxes that I filed as tax refunds. That's money that would have gone to the government, is hitting my bank account, my corporate bank account. I can use that money to buy an IFA permanent life insurance policy. So now I have belts and suspenders. I've got a pension plan and an IFA insurance policy all running together. So they're not at cross purposes. They actually work together. Or like I said, you can have the policy inside your pension plan as an asset.
Awesome. So got a couple more questions here from Steve. I've been an independent mortgage agent in Canada for 15 years, just incorporated now. Previously, I was an agent for a mortgage brokerage, basically the same as a realtor. Can I fund the pension plan for the past 15 years of service?
The problem is this: in order for previous years of salary to count, remember it's only T4, so dividends and stuff like that don't count. They have to be relating to a company that's participating in the plan. So for those who only incorporated last year, but got salaries from some other broker or some other entity, since those other entities will want nothing to do with the PPP, typically, we can't recognize those years of past service. We can only from a company that's going to be participating in the plan. that's going to be sponsoring the plan. There are some exceptions to that, but they're really rare. They're really tough hurdles to jump over. Like you can have what's called a predecessor employer. So if company A sold its business to company B, and as a result of this sale of the business, all the assets and the employees shifted over, and then company A disappeared, is wound up or bankrupted or whatever, the salaries that were paid under company A could be used for the pension plan relating or sponsored by company B, because company A would be seen as a predecessor employer to company B. But that's really tough. You have to prove it to CRA. You need legal documents that the business was sold, blah, blah, blah. The other one is if you amalgamate. So if company A amalgamates into company B, and company A used to pay salaries, then those salaries will qualify, even though company A doesn't exist anymore. It's been merged into company B or Amalco. So short of those couple of exceptions or special cases, very, very difficult to recognize the past service.
That's awesome. That's really good information there.
Yeah.
If your PPP has $1 million in it, is it possible for the plan to borrow additional funds to purchase real estate with it?
No. No, there are rules on borrowings like CRA and the federal regulators of pensions, OSFI, that governs these federal investment rules. They put very strict limits on borrowings from a pension plan.
Okay. Do you see anything changing in Thursday's federal budget with concern to PPP plan at all, or?
We haven't had any rumors or any advance warning that they were going to attack pension plans. So I'm not expecting anything in this budget, but we've been surprised before in the past. Remember, this pension legislation goes back to the very first Income Tax Act in 1917. This is the very first time Canada passed the Income Tax Act to finance the First World War. So in that old statute, which was very thin compared to today's statute, it had some provisions about contributing to a pension plan and claiming tax deductions. This is how old and venerable this legislation is. And all the government employees in Canada belong to gold-plated pension plans like the ones we offer. So that would be a lot of people to upset if they decide to attack pension plans.
Okay. You kind of answered that earlier. What if a PPP has a surplus and we sell the company? You kind of answered that a little bit, but maybe.
Sorry, maybe rephrase the question.
So what if the personal pension plan has a surplus and we sell the company?
Well, so first of all, it's a good question, because a company can be sold in one of two ways. A company can sell its assets, in which case the company, the actual corp, remains intact, in which case nothing happens. The PPP continues to go with the company. And if there's surplus in the plan, well, it stays in the plan, and it can, surplus can be dealt in a number of ways. One way is to leave it there and let it grow, tax sheltered. Another one is to distribute some or all of it back to the company. And the third way is to pay it out to beneficiaries. So there are different things you can do with surplus. I only focused on leaving it alone when mom and dad pass away and the kids are part of the plan, but that's not the only thing you can do with surplus. So on a sale of assets, it's business as usual. On a sale of shares, it's a little more tricky, because the new buyer, the new shareholder, doesn't want to deal with this pension plan, and the pension plan is attached to the company they just bought. So what do we do? Well, again, very flexible, lots of options. One option is to wind up the plan and transfer the assets to an RSP or a RIF, or buy an annuity. you buy a special annuity under section 147.4 of the Income Tax Act, there's no tax consequence. If you transfer your pension assets to an RSP, there's a certain amount that can go tax-free into the RSP, but then another piece of it will be cash, and that you have to pay tax on, including any surplus. So not as advantageous. But if that's not the only option, you don't have to wind up the plan because the new owner doesn't want to touch it. You could assign it. You could do an assignment and assumption agreement and assign the pension plan, so the bundle of liabilities and assets, to a new company that you own, like a holdco. And say, holdco is now going to be paying me a salary, or new co or consulting co. It's going to be employing me. So my in French, mon baluchon, my ball of stuff, I'm going to move it over to holdco or new co, or the new company that's taking assignment of the pension plan. That way, the new shareholder doesn't have to worry about the pension plan because it's been assigned away. They don't have to fund it. They don't have to care. They don't care about it. It's not there. It's gone. So that's another option. And what we typically recommend is that if you do have a holdco, or if you don't get one, have it sponsor the pension plan, and have your operating company, the one you're most likely to sell, have that be a participating employer. So you end up with two companies feeding into one pension plan. And then when you sell OpCo, because that's the one that has value, maybe because you want to trigger the lifetime capital gains exemption for whatever reason, OpCo will cease to participate. It will cut its umbilical cord to the PPP, and Holdco is still sponsoring. So Holdco continues with the plan. So that's the cleanest way of doing it. Very simple.
What if just another question that I have, actually, that I never thought when we spoke before. Once, let's say, you collapse that company, and your pension plan, let's say originally you wanted to take out $100,000 a year out of the personal pension plan, and because your PPP is producing so much cash, you want to start taking out more money. Are you able to change how much cash you're taking out of the PPP, or is that something can change over time, or no?
So you're not allowed to muck around with the promised pension, like the 100,000.
Yeah.
But if you have surplus, you can say, I'll take my 100, and you know what? I'll take another 50 of surplus. So really, I'm taking $150,000 a year. But if 5 years later you say, you know what? I've got another source of income that's bringing you taxable income. I don't need to take 150. I'll go back to 100. Then you can still get your 100 and stop taking surplus out.
Oh, that's pretty cool.
Yeah.
Awesome.
You can also, just so you know, you can also designate a registered charity, like a hospital, a university, a church, a synagogue, whatever, anything that's charitable that doesn't pay tax. You can designate them as a beneficiary as well of the pension plan. So you could say 90% of my money is going to go to my kids, but I'm reserving 10% of the cash that's going to go to my alma mater. And because they are tax exempt, when they receive that cash, they pay no tax on it. So it's a way of doing some charitable gifting from the grave. So it doesn't impact your lifestyle, but on the way out, you're doing something nice. You don't have to do it. I'm just saying it's an option for those who are inclined.
Interesting. One more question from Steve that I wrote down here. Ontario changed the lira rules, but what if you move to Alberta? Then we convert our liras to the PPP?
Are you talking about an Ontario lira?
Exactly.
No. Well, no. The answer is no. There used to be ways of doing it, but we won't recommend these shady ways. So the answer is no.
Okay.
Now there is a way of unlocking 50% of a lira in Ontario starting at age 55 and age 50 in Alberta. So there are mechanisms to unlock locked-in monies from liras if you're the right age. Also, if you become a non-resident after 2 years, for some provinces, all of your lira becomes unlocked. So that's another option. But normally the regulators take a dim view of people who try to unlock lira money by moving it to another jurisdiction.
Okay. Ludi's asking, is this available for people that live in Quebec?
Oh yeah, we have lots of Quebec clients.
And then Hong's got another question here again. Is setting up a PPP is a no-burner? What are the risks stopping people from doing this?
Well, it's the real Achilles heel is that because it's a highly regulated pension plan with actuaries involved and a certain level of complexity, there's a lot more paperwork than going online and 15 minutes later opening up an RSP account. Okay, it takes weeks to collect all the documents, we review them, then we crunch them with our actuaries, prepare a report. We typically get verification of T4 income from CRA that could take weeks, sometimes months. Then we have to file everything, like have a big massive stack of documents signed. Now, obviously we do electronic signatures nowadays, but in the old days, it was little flags, like a corporate closing, you know, people were freaking out at the amount of paperwork that comes with having a true pension plan. But that's really the only disadvantage, because everything else is better, like more tax deductions, better credit protection, more investment freedom, ability to pass it to your kids, protection if you become a non-resident, because none of the money's taxed under the departure tax.
And
right?
And your fees even deductible, I believe.
Our fees are covered by the tax refunds that we generate. There's so many tax refunds that you don't have otherwise that come into your coffers that pays for our fees multiple times over. So our fees really irrelevant.
And then Danielle is asking, can this be used somehow to shelter profits from U.S. real estate transaction tax sales made by someone who's already employed in Canada, example, working for the city or government or a big company?
Well, I don't think so, because those employers in Canada are not going to set up a PPP unless you're like the CEO, right? That's the problem, is that if you could get the city of Toronto to say, hey, I'm a manager in this department and I want a PPP, not your crappy RSP, then that'd be amazing. You could come to Mathieu and say, hey, buy me some US real estate. But the city of Toronto as an employer is not going to do that. So it restricts the market to just people that are like they have their own corporation, family businesses, or sometimes highly compensated top C-suite executives that have enough bargaining power with the board of directors or the HR committee of the board to say, hey, I don't want to be in the group RSP with a receptionist. I want to have a PPP. Then they will set up a PPP for that one individual. But most people don't have that bargaining power with their employer.
Okay. So Danielle is kind of asking.
Rephrasing it? Maybe I misunderstood.
Yeah. So I meant to say by setting up my own corporation. So you have to be able to draw a salary on a T4 income to be able to qualify for this.
Yeah. You have to have a pretty nice, business on the side that can generate salaries. Then you're good. But most people that are employees of a large company, they don't have a side business. They don't do Avon things or Tupperware parties, or they just have their paychecks, so they would not be eligible. But if you have a side business, then it's definitely something to look into.
And what if maybe if you can talk about maybe the fees. Martin's asking, like, what's the cost of opening a a PPP maybe?
There is no setup fee. We waived those 10 years ago when we came into the marketplace. There's no setup fee. Most other pension plans like this charge a setup fee. We scrapped that, and then forced other people in the industry to scrap theirs as well, which didn't make any friends. We didn't make any friends when we announced that, but we're like, no, we're going to work with our clients and earn their trust and build wealth with them. We're not going to gouge them on day one because we had to do all this work to set up the plan. We'll take the risk that you set up the plan with us, and then once you're set, you fire us to go to your buddy that can do the work for cheaper. We've had a couple of cases in the last 10 years, people did that to us. Okay.
So this question is kind of coming up right now from a few people. What is the minimum yearly salary or size of the company that makes sense for a plan for the PPP?
Great question. We've run a lot of sensitivity analysis to answer that question. I had a guy in Quebec who only had $30,000 salary. And because the projection was long enough, it actually made sense for him. He was much better off after fees in upgrading from an RSP to a PPP. But I wouldn't recommend that low of a salary. I think back of the envelope, if I were to put my finger in the wind, I would say, if you can't afford to pay yourself $60,000 to $70,000 a salary each year, then maybe you're too much on the edge and this is not for you, right? Like we think that there has to be a minimum level of salary too, because all the contributions relate back to the salary. So if you take too low of a salary, even though you can triple your contributions, it's not going to move the needle.
Okay.
And the other question was, how much money should the company be? Like, what kind of surplus available for contributions? 40,000 and up. I mean, if you're saving money in a corporate non-registered account, that money should be in the PPP instead, because the corporate non-registered account, first of all, you had to pay tax to put money in there because it's retained earnings. So you pay tax once. Then you're going to be paying tax every year that you make money at a high rate, tax number two. And when you decide to take money out of that account and pay yourself a dividend, you're personally going to pay tax a third time. So unless you love paying taxes, this is not the way to become rich, right? You want to pay no tax, put all the money to work in US real estate, grow it, pay no tax on the growth, and then, depending on what you do with it, either become a non-resident, do income splitting with a spouse, and whatever, to kind of manage your tax bill 20, 30 years into the future.
There's a good question here from Julie. What if the corporation is a holdco that has no business activities rather than holding shares? Is this type of corp can still pay the owner's salary in order to implement this PPP?
Yes, but subject to this. The accountant for the holdco has to determine that whatever level of salary that's being paid for managing the assets, the business of holdco, is reasonable for corporate tax deduction purposes. So if you take an unreasonable salary out of holdco and CRA says, so what exactly are you doing for that $300,000 salary you're pulling out? You're looking at an accountant's report once a year. I don't know. We don't think that that's reasonable. They might disallow that deduction for holdco. But if it's a reasonable salary and there is work, if your holdco has a bunch of properties and you have to deal with property appraiser, with brokers, with whoever's managing the cash flow in between transactions, whatever, due diligence, then there could be a very, very good case that the salary you're pulling out of holdco is a proper deduction, in which case you can have a pension plan, because the law doesn't care whether you're active income or passive income. So long as there's an employment relationship, you're in business. You can have a PPP.
Awesome. So I'm putting in the chat too. We've put a whole bunch of information on our website too. It's tied into Jean Pierre's also with the information he provides too. So if you guys have more questions, feel free to reach out to myself or to Jean Pierre's team. And we'll be emailing everybody his contact info after this. And if you guys also want, we can do a bit of networking after this. If you guys have more questions, feel free to ask. It's your chance to ask Jean Pierre, the expert in this field.
Free legal advice. Come on, guys. Shoot.
It's a free lawyer. You don't want to know his hourly rate.
I'm happy to stick around for another half hour for whoever has questions. Those that have to go can go, but those that want to stick around, I'm happy to answer questions. This is, for me, I enjoy doing this. So
awesome, guys. So I guess we'll end the meeting like this. I'll open it up to some networking. If people want to turn on their cameras and ask questions or whatever, talk real estate, let's do it. Maybe I'll let Hong start because I know her really well. So maybe you want to introduce yourself to the group and go from there.
Okay. Hi, everybody. My son's listening in. I told him it was a kid-friendly session, so he's been sitting in.
Hello.
So my name's Hung Lu, pronounced like Hong Kong. I am a traveling full-time mother investor, currently in BC. And my side business is to educate families on how to be mortgage-free in 10 years.
Awesome.
So Hong, I should have mentioned that, and different people have different views, but you can use the Smith maneuver with a PPP,
Okay.
and we call that the enhanced Smith maneuver.
Okay.
Because normally with a Smith maneuver, you have a readvanceable mortgage on your primary residence, and then you draw from the line of credit and you buy, let's say, real estate with a non-registered taxable account. And you make money there, and then you've got your tax refund, which helps you pay down the principal sooner, which is great. Like, I know Robinson Smith from the Smith maneuver, Fraser's son.
Yeah.
Great. But with the enhanced Smith maneuver, you can push this even further, because if you draw from the line of credit and invest in your own company,
Mhm.
you're investing with a view of profit.
Correct.
Therefore, the interest payable to the mortgage company, to the bank, sorry, is also tax deductible personally.
Correct.
So you've got that nice little tax refund that you can use to pay down the principal sooner and create new borrowing room, because it's a readvanceable mortgage. So that's fine. But where
So are you saying to take the line of credit from the primary and use that to fund the pension plan?
well, first you fund your own company.
Yes.
You lend money to your own company.
Oh, I see.
Shareholder
Okay.
loan. So you
Gotcha.
get
Yes.
you get into the bank account of your company.
Correct.
Now it's working capital, like
Correct.
any other dollars you have in your company.
Yes.
So now there's no excuse not to contribute to a pension plan, because you
Gotcha.
got the money. So now you're contributing to the pension plan. That creates a tax deduction, which means that when the corporation makes money from its customers, instead of keeping 9% or 12%, depending on your province, for CRA in the form of corporate taxes, you can take that same money and repay the shareholder loan, which is tax-free. So now that corporate tax money that you never gave to CRA ends up in your bank account personally,
Okay.
with no tax, which
Gotcha.
allows you to pay down the principal even faster.
Correct.
And you've got money in a pension plan that's going to be growing tax shelter. And now that you have a pension plan, you can roll in your RRSPs in there and really make that balloon, and then turn around and call Mathieu and say, hey, how about some US real estate?
So if somebody has money in an existing pension somewhere else, are they able just to transfer that over?
Well, depending on the province, but typically the answer is no, because it's registered.
Yeah.
And these plans are for connected persons that are shareholders that aren't registered. They're registered, but they're not locked in. Sorry, they're registered but not locked in. So the normal pension rules, like for, I don't know if you're working for BC Hydro or some big employer in BC, and you have money in their pension plan, they won't allow you to take this locked in money and transfer it to a PPP that you set up for yourself.
So there's no way, because it's funny, I was on a call today with somebody that's quit their job and it's pulling their pension money out of their plan. So, and she's like, yeah, I'm going to pay around 51% tax on pulling out the money. She's going to reinvest it in real estate, but there's no kind of way around this in Canada.
Before February 15th, 2021, we were able to take government pension plan monies or big company pension plan monies and transfer all of it, the commuted value, tax-free into a PPP. And we did that with teachers and school principals and firefighters and nurses and doctors that were part of these big public sector plans. We were transferring millions of dollars out into PPPs with no tax. Unfortunately, the budget in 2021 made that no longer possible.
Okay, interesting. All right.
Sorry, so I had another question, Matthew, just now that I'm thinking about it. So with the PPP, is there some sort of requirement or criteria that makes it so that we can work with your firm, Matthew? Or if we went to another firm, is there something that we have to look for to be able to say, yes, we could use our PPP with that company?
So the answer to that, you can go through Jean Pierre. You guys don't have to buy my product, but Jean Pierre can kind of go through that a little bit more with you. But you can bypass me if you don't want to invest with me and just go directly to Jean Pierre. That's no problem.
I'm not asking because I'm wanting to.
No. It's okay. No, it's a valid question. It's a valid question. It's no problem.
Yeah, we're like the Hard Rock Cafe. Love all, serve all. That's the motto. So we're agnostic. Like, we don't manage money. So of course, we partner with lots of people. I really like Mathieu's company because I think that's high quality, not correlated to the stock market, and especially the US exposure. So that's why we're here tonight. But the truth is, we have clients across the country that are investing in all kinds of stuff.
So if we put the money in the PPP and don't do any investments with it, then we've sort of missed a lot of the benefits that come from having this PPP then.
Well, you get all the tax advantages. So you save on taxes because you get an offsetting tax deduction. But if you leave it in cash and you do nothing with it, then you're not really growing your wealth that quickly.
Right. Okay, got it.
I think Martin has I saw a hand up for a while.
You can speak French with him, Martin. Il est vraiment francophone, Jean-Pierre.
Ah ouais, ok.
Bonjour, mais c'est Julie qui va poser la question. So our question is, we have an investment property in the US. So it's a LLC. LLP, sorry. No, LLC and LLP. Anyways, we don't currently pay Martin a salary for managing the investments. And we also have a Canadian company for consulting. So both are not related. So two questions: in which company would we set up the PPP? And how do we link the two?
So you would want to set it up with your Canadian consulting company. Because remember, PPPs are Canadian registered pension plans that are anchored in the Income Tax Act of Canada. So you want to have a Canadian nexus. Now you can have more than one participating employer. So it is possible to have the US company participate as well alongside the Canadian sponsor. But the cleanest is to do it through the Canadian company. It is possible for your US company to set up the equivalent of a PPP in the United States under the ERISA, the federal pension legislation, but I don't want to go down that rabbit hole tonight because it's a whole different conversation. But that would be the cleanest thing is the Canadian company sets up the PPP, and then if you want to add another employer, you can, and then you can invest the PPP assets across the border, like we talked about during the presentation, if that's the investment profile you're looking for your pension assets.
Okay, thanks.
Philip, you have a question?
Yes. Like when you have our RSPs and want to invest in the real estate market, typically it's got to be arm's length or something like that. Is there a similar process? Let's say I want to use the PPP to invest in my own project through another entity. Is there something that prevents us to do that?
Same thing as with other registered assets. There is a prohibition on what's called related party transactions. There are also prohibited transactions. So prohibited transactions are found in the income tax regulations, and they say you can't take your pension money and buy shares of your own company or shares of, a subsidiary that you own. So that's a prohibited. A related party transaction is, it says you can't take money from your pension plan and invest it in your spouse's company or your kid's company, because those are related party to you. So the government doesn't want any self-dealing. They don't want you to recycle your own pension money into stuff you already own. They want you to invest like a real pension plan would out in the market with parties that are operating at arm's length on market terms with due diligence, right? To make potentially more prudent investments.
Okay, but to make sure I understand, like the example you had, like listen, we're four unrelated parties that want to invest into a company that through Mathieu and Mada entity, and we want to invest together in some sort of
That's
a project.
perfect. That's what my slides were showing.
Yeah, but it was through we're all shareholders of the same company, and when investing our money, that's
No.
I'm getting it.
That's fine. That's fine. That is, you can funnel your money through that pension real estate company.
Okay.
Yeah.
But you're a shareholder of that company.
Well, you're not a shareholder. Your pension plan is.
Okay.
You're different from your pension plan.
Okay.
I think what he's referring to right now, there's a group of people going around Quebec telling people you can use your RSP money and you can borrow against it. They're using a publicly traded company, and then they're kind of benefiting on the back end of it. So
RSP strip?
Yeah. So basically once CRA finds this out, and especially they've been advertising online about this, that thing's going to get collapsed as quick as possible.
That's a scam. Those are all scams. That's a scam.
Yeah, I'm not sure what you're referring to. Mathieu.
Okay. That's what I thought you're referring to, because there's been a lot of noise about that in the last 2-3 weeks, because we offer that with one of our portions of our company, arm's length, but it's there's some, anyways, that's a different subject.
Yep. Okay.
No, but you see the graph I was showing where you have 4 different PPPs that are unrelated to each other. And shares of a pension real estate corporation, right?
Yeah. Okay. Yep.
That's fine, because
Because you're not the owner of the corporation.
You're not the owner, and also you're not investing in your own corporation. You're investing in a piece of real estate that Mathieu found.
Yep.
So you're not recycling your own money into your own assets.
Okay, got it.
That's why it's permitted. Anyone else?
Manny, you're next on the board.
Sure. I'm just a little embarrassed to start talking because I really wanted to come into this meeting, and then a few clients called and I chopped the meeting, unfortunately, but I had to relate to clients first. So
It's been recorded, so you,
yeah, I'm waiting for that. And I see, Matthew, that you are going to the States, I think next month or something, and
Yeah, in a
offered
couple of weeks. Yeah.
for a couple of weeks, and you offered people to tag along.
Yeah.
So I'm just trying to scratch the idea of maybe going with my investments into the States. And so I don't even know how I came across your profile, or you mailed something. I'm trying to figure out how we were even connected, and I can't really say that. I
It's
know.
probably my marketing team that took care of that for me.
Probably, right? But you are, what I'm understanding is you're doing something similar to a REIT in the States.
So I have two things. Where we kind of have your typical kind of syndication US model where we get partners, or we have kind of a REIT where we just give a flat rate of return on your money. We have a bond that we issue, but we offer a couple different options to our clients.
Mm-hmm. And you're in Ottawa, right? I'm
Correct, yeah.
BC. So, but you do nationwide, right? You don't
Correct. Yeah.
differentiate one from the
Yeah.
other. Yeah, it's interesting, as much as I've been in real estate for the last probably 10 years since I started investing, and 3 years since I started to be a mortgage broker myself. As much as I know, there's still so many aspects of these things that I don't. And thank you, Jean Pierre, for again, I just got nimbits of it, but I kind of realized that there's other better things I can do with my money besides paying taxes on it, right? I'm not into tax evasion, but tax avoidance is not a bad thing, right? If there's tools that allow us to, optimize the way we deal with our money. So I definitely, as much as I know, I still have a lot to learn. So I'm mainly trying to be a sponge.
Yeah. Good. Well,
I
glad
mean,
you're-
the only thing very interesting, what you said, Hong, about you're teaching people how to be mortgage free in 10 years, which is absolutely a great goal. But from where I'm sitting as a real estate investor, you should never be mortgage free, right? If you already have capacity, you should squeeze it out, buy something else. So being in debt is not a bad thing as long as the debt is managed and serviced and allows you to grow.
one thing I forgot to mention is the investment management fees that are levied by people that manage PPP assets. Those are also tax deductible within a PPP. So let's say you have $2 million at the bank and you're paying 1% on assets. So 20 grand a year in fees to your bank broker. That 20,000 is non-deductible because it's an RSP. The second you roll it in tax, though, 2 million tax free into the PPP, and they're charging you 1% to manage your PPP assets, that $20,000 is now a brand new corporate tax deduction for your business.
Mm-hmm.
So-
So when you say PPP, you mean
Personal
the,
pension.
personal pension plan?
Yeah.
Yeah, so you just opened, I think, a rabbit hole for me to crawl into. I have to do a lot of reading about that because the first time, and up until now, I've been a sole proprietor. I'm actually in the process of incorporating this year. So I guess I wasn't aware of all those terminology just because I'm just not there yet.
Yeah, sure.
The evolution of my business. So
Yep, no worries.
yeah.
I just forgot about the fee deductibility because if you're a really successful company and you're paying 26.5% corporate tax, to
Yeah.
Han's point about reducing your tax burden,
Absolutely.
well, just by making your fees tax deductible, it's as if your dollar goes a lot further.
Yeah, no, absolutely. Whatever I can pay from my gross earnings and not from my net earnings is keeping half of it in my pocket,
Bingo.
right? So
Yep.
that's kind of, so thank you for putting me on the spot, but unfortunately I don't have anything smart to say.
No
I'm here
problem.
to learn.
Danielle, you want to go?
Sure, thank you. Merci, Jean Pierre. That was very interesting. I think you mentioned that RRSP money that's held into an RRSP could be transferred in the PPP, correct?
Yep.
It's not my case, but imagine somebody who had a fair chunk of money into their RSP and wanted to create a corporation, then set up a PPP and do the transfer. Then there would be a lot more flexibility for them to invest.
Yeah.
So they may not be able to pay themselves a lot of T4 income. They might still be able to do a little bit, but wouldn't that be interesting for them?
Perfectly acceptable. You can have
Okay.
a very small salary and very small contributions to your pension plan, but that doesn't prevent you from transferring all your RSPs, all your RIFs, any spousal RSPs, if your spouse is also a member of the plan, can transfer all of that in one PPP and now do some interesting investing.
That's right. That's really what I might have been interested in, because even if your RSP portfolio is small, if you've got flexibility and you know where to invest and you can grow it quickly, that might still be advantageous even if you start small. Okay.
Why not?
How do I find out more about this?
Well, my email was, I think, Mathieu, you put some stuff on the chat and on the website.
Yeah.
I don't know if you.
Yeah, I'll put Jean Pierre's email in it. Or do you want to put you want me to put your assistants there, Jean Pierre? Or just use
maybe my assistant, and she'll book a time with Danielle and anyone else that wants to keep chatting at your leisure. I mean, to me, this is just the start of a conversation, and I think we're all trying to achieve the same thing, to make money, pay less tax. We just happen to have the best product in the country for that, but you know.
It's just I've invested in tax sales in Quebec, in the province of Quebec years ago, and I mean I paid 20 cents on the dollar for properties. I'm also aware that it's possible to do the same thing in the States. It's just that I'm trying to see how I could structure it to delay taxes. It's not like I don't want to pay taxes, but I'd like to pay taxes when I retire, right?
Yeah, when your income is lower, typically.
Well, or so that this is one possibility. I'm sure there's lots of other ways of doing it, but this is the first time that I see a glimmer of a possibility here. Okay, thank you.
You're welcome. Enchanté.
So here's a question, because one of the things that is on my mind, okay, I'm building this, portfolio with assets. Now starts the question of how do you transfer the wealth with triggering the least amount of taxes possible?
Transfer the wealth to whom?
Kids.
Well, I guess you missed that part of our presentation, but the pension plan allows you to do what's called an intergenerational wealth transfer. So all of the money that you built up in your pension plan, you can give it to your kids with no tax on your death, which is not possible with an RSP or a RIF or even with the shares of your own private corporation. Because those tools get taxed under the deemed disposition rule,
Mhm.
but not the PPP.
Okay, but so how do I transfer assets that are
So you have to
real
put,
estate assets?
so, well, they stay in the plan. It's the plan that owns the real estate, not you or not your kids. It's the plan.
Oh,
And the plan doesn't die. The plan is eternal. So if your kids are on the payroll of your company at some point in the future, you make them members of your pension plan. Heaven forbid something happens to you and you die. All the money that you accumulate for your retirement stays in the plan, and now your kids get a windfall. And if
So
they
the
don't need the
plan
money,
can-
just let it grow.
so the plan can hold hard assets? Like the plan can own my condo in Langley?
Well, not your personal stuff, but it can own condos with tenants in it that are paying rents. It can buy real estate, it can lend it
I
out in the
get-
form of mortgages.
So is there a way to move my assets that are on my own name into a holding company that is, I have to sell them to myself?
That was one of the questions that people asked after the presentation was over. You
Mhm.
can do what are called related party transactions. You can't recycle your own money into stuff you already own. You can't take your pension money to buy an asset that you might have owned personally,
Mhm.
put the money back in your pocket and transfer the condo in the pension plan. That's not permitted.
Okay.
Yeah.
So 2 condos that I'm buying and completing on them in 2 months, can I buy them under the PPP?
Yeah, if you have a PPP, it buys the condos as an asset
Mhm.
from some stranger. And
Okay,
it becomes an asset of the pension plan. So when you flip the condos and you make a pile of money, none of it gets taxed because it's a pension plan.
okay. But so I need to be incorporated first, set up the PPP after, and then complete on
And
them.
then fund, yeah. You're gonna enjoy the video when it's
Yeah, I
available.
will.
Think you'll get a kick out of it.
All right. All right, guys, it's pretty much a wrap. It's past 9 o'clock. I don't know if anybody else wants to add value or share anything before we get off the line. But again, thank you so much for everybody for joining. I will be sending a recording of this to everybody that